So this is going to be a quick little, nice pre-FOMC expiration June opex midweek scan, right? And just kind of what's been going on, what I'm expecting for the rest of the week, and why. So, um, we obviously have expiration day. We have the Fed meeting, right? And those are two things that can, you know, those can get extensive, right? Um, the volatility becoming unpinned, such an aggressive, volatile event, right? Something can happen. Volatility can come one way or another, and if it doesn't, then it'll offer a sick flush trade, right? So we have a very interesting time period with how this happens, right? Because we have Juneteenth tomorrow, so the market's closed, and then we have Friday, June opex, um, and we have the Fed meeting today. So if you're familiar with dealer flows and the positioning and how those can kind of move the market, how that positioning can influence the movements of the market and the draw and the extensive or exacerbate the moves or compress the moves. Um, then you're familiar with Vanna and Charm, right? Vanna, the change in the delta with respect to implied volatility, and Charm, the change in delta with respect to time. So when you have a large binary event like the Fed meeting, and you also have a day off, right? The implied volatility is going to drop on Thursday especially if the move is not met, whatever the implied move is, I have no idea. And then the charm is going to kick in, the decay from time is going to kick in, and you're going to have those dealers, hedge their books from the delta decaying due to charm over Thursday, right? Because um, I'm pretty sure they can't do it on Thursday. That wouldn't make any sense because the options market would be closed. Futures might be open for a small portion of the session, but they wouldn't be able to calculate the delta needed to hedge their position, right? And I looked at it. I don't know if it's true. First time in at least 5 years that this has ever happened, if not ever. Probably not ever, but where there's a day off before an options expiration, nonetheless, before a quarterly options expiration, especially one like June. So um, this has the potential to get really volatile this week, right? We're still trading the confines of last week's session. We obviously had the new week opening gap up to begin this session, right about 0.5%. Continue to rally into the Thursday gap fill or Friday gap fill from the war news, right? And the imbalanced print from the Wednesday reversal, midday post CPI kind of failure, distributed range above the top, and then kind of lower high that we established. All of that coming off of the kind of false break. I can go over the entirety of this range, but all of that coming after the kind of false breakdown on the fifth, right? The sixth kind of giving you that pin above that high, above the 595 range, and then the kind of exhaustive look into data where we get that leg lower, and then the lower high on the Thursday print that you have a notable seller digesting this 3% move. Have a lot of red flags overall. Energy last week, Wednesday and Thursday, printing some very, very healthy candles, right? On a sector that's kind of underperforming and kind of consolidating inside of this April range, right? And printing some relatively healthy candles, right? That's a big red flag when you see money rotating and bidding energy. And you also had volatility up 4% last Thursday, right? With SPY kind of closing at the highs on very little volume and no kind of bid in the tape the entirety of that session. So that's a red flag as well. That's something that I kind of keep in mind. And I did kind of I sold my puts at close, but in hindsight, this was a very good short from the continuation, especially with the vol pop. I was green like 30% at my entry on Thursday, a day later. So especially with the vol pop, the continuation from Thursday into Friday was very evident. I kind of paper handed that a little bit with the positioning I took on Wednesday, targeting this June 6th gap and then this high from the week of the 19th. Um, which we ended up bidding and closing above on Friday of last week. But we have the gap up, the kind of exhaustion, the kind of weaker close, right? The gap down yesterday's session, the draw in the NWAG, the subsequent lower high, and then the breakdown where we begin to see some climaxes build out within the new week opening gap fill, heading into CPI, or heading in the Fed meeting, right? And we still have a gap to be filled from Tuesday's session at 602.68, right? And obviously up here at 60.30, right? And then on Q's at 534. So still trading in the confines of last week's print. Still not a very bullish structure, right? When you pull up the extended hours, it really gives you a great perspective of things with the court ruling, the way these after hours moves happen. This Thursday news pop, the Friday news pop on the 6th, right, where we had that false breakdown, CPI, kind of giving you that top at 606. And then we get the gap down Friday off the war news, the lower high, and then we're still in that window with flows, right? My issue was I swung short over the weekend with no room to add, no leeway into a window of flows, right? And even though we still had that kind of bearish structure, that exhaustion, that the intra-week distribution in the CPI being kind of the catalyst in the top, even on a good print, right? Especially last week, the tape was getting smacked with news that was relatively bullish at the high of days on volume, giving you subsequent aggressive legs after on Tuesday's session, following a very low volume, small spread print on Monday, and then the cold CPI print getting faded as well as something that you have to kind of take into consideration. But, still bearish, but also kind of playing the window, right? Like I said, we're still in the confines of last week's print, and we're coming into the Fed meeting. I'm coming in short NVIDIA puts, or long NVIDIA puts, I guess you could say, short NVIDIA exposure. I originally tried this back here, and I just kind of realized it was way too early. And then we had the kind of notable seller that end of week, that kind of fake out on the 6th, and then we're entering that window of the flows starting the week of the 9th. But this underperformed substantially. This has a large seller at the tape. I showed it in the scan over the weekend. At the 145 spot, right, being those June 9th highs where we saw the tape begin to get hit. And we're seeing a distribution build out on an hourly perspective, in my opinion, that should pull us down to 137. I was green 30% around 1 o'clock yesterday. A lot of that was due to the VIX spike. I'm currently green around 9, but I have a lot of room to add, right? So if you want to go ahead and explain this position, we obviously have, I'm just going to talk about this range, right? We have the kind of, in my opinion, preliminary signs occurring the week of the 12th, following the breakaway gaps in the stall, with that May 21st print being relatively aggressive volume-wise and a notable seller at the highs that day. The fill of the 130 gap from the 14th, and then we have the run up into the report where we gap up about 5%, fade 7.5% from the deep sea gap in the June or February highs, and then get the reversion back to this print, the digestion of this print, the highs of this print where there's a lot of money built up, and a draw just specifically into that range. And then we kind of see that seller begin to show his hand. Those flows kick in, and then we kind of see that notable seller continue to offload inventory and establish kind of a resistance up here at 145, and we get the kind of CPI print, relatively ugly, the kind of fake out candle on Thursday, right, with no true bid, and then the continuous sweep of the June 6th gap for the second time on Friday of last week, the 13th. So not really like a swing I'd build out. Not a good weekly candle closure by any means, but pinning it above this gap is relatively not bullish, but you don't really have. When you look at 145, you don't really have such an aggressive seller. You obviously have the Monday print establishing that kind of resistance. The Wednesday print kind of giving you a notable footprint, not even pulling 145. And then Thursday, high of day and close being 145. You haven't really taken out those highs, right? You haven't really changed those hands. You haven't really seen that draw to that liquidity that swept to spark a reversal, right? So now what we see, right? We see the new week opening gap. We see a rally to begin the session, and then we see, right, what in my opinion is a continued distribution above the earnings candle high, a massive influx of volume pour in on Monday, right? And it happens above 145. We pin it under there for close, and then we have the subsequent inside bar yesterday on Tuesday's session, which is not, I'm not surprised at all by that, considering the fact that we have the Fed meeting of expiration and the Fed or options expiration this week. A loaded event with opportunities to generate a lot of volatility. So I'm not surprised that the Tuesday print is an inside bar, and now we've swept the INWOG. I positioned right here, July puts, right, and the execution on this trade kind of differs, right, depending on what happens. So I have a decent size in. I still have room to add. I still have cash left over for the long I kind of won on Friday, which I'll talk about. But that just has to do with the dealer positioning and a potential squeeze, especially if we get a breakdown today, which also discussed the similarities to December 18th in volatility and indexes and timing. Just a speculative idea that I have that could potentially play out, right? It's something that I'm keeping an eye on that could potentially play out, but not necessarily something that I'm betting on short-dated exposure, right? So obviously I've given up about, from close yesterday, I was up 20, now I'm up 5%, but the positioning up here, right, is where I got the majority of my ads. But we have, a 4 million volume print on this 15-minute candle, right? We have highs that were not necessarily taken out, right? I want to see those highs taken out, similar to 145. I want to see the high volume highs taken out, especially on a sequence like this that can genuinely give you, that true UTAD, right? Especially as we have a draw into the INWOG, right? We can kind of swipe the external low from that daily inside bar and spark a nice reversal to the highs of that print where we have a lot of volume and liquidity and money built up that could spark that draw even lower, right? So, I was up like 25% low of day, now I'm up 5. I have July exposure with pretty good ads, right? And I have a clear, well-defined risk on this trade, right? My risk is just a loss of 145 on a daily perspective. And my target, depending on how this develops, my targets are 142, 140, and then 137, right? Now, if we see 142, which is the INWOG fill, the deep seek gap, and then this subsequent June 6th closure, if we see that before we see 146, right? If we see this kind of maybe breakdown off the Fed meeting, a couple percent, don't know what's going to happen, but maybe, I'm going to cut my position for what will probably be a 40 to 50, maybe 60% return depending on vol. And I'll reshort it again at 146, right? With the same risk, the same exposure, same expiration, just not going to let that go target back to red, right? Now, if that doesn't happen, if we see 146 first, I'm probably going to wait depending on when, right? If it happens today, I don't think I'm going to take any ads. If it happens tomorrow, or Friday, I might. And I might do that just because of the fact that we're leading into the window of flows gone. Obviously, we have the end of quarter and end of month flows. That JPM collar is relatively important. And the JPM collar is at 5,900, which is also equilibrium of this range. So that's something to keep an eye on. If we do get the reversion, the decline a couple percentage points, maybe even 2 to 3%, right? Before the JPM collar kicks in, we could see that kind of revert and pin around that range. I don't know though. I'll find out. But yeah, it just depends on what we see first. I am fine going back red, keeping the same risk. And honestly, if this high is taken out, this is a much more mature distribution in my opinion, especially if you can see the tape get a little bit aggressive up there. I can get more size, keep the same risk, and at that point, I can take some off here, target 140, and then target 137, which is equilibrium of this range about, and we have that gap fill from Tuesday, the 10th, or the 3rd, not the 10th, this is the 10th. And then I'd look to just short lower high down to 131 potentially. So, that's my video trade, right? That's all I've done this week. I haven't taken anything else. Actually, no, I did take a spy short here on the gap fill, and I broke even. Wasn't really moving like I wanted it to, so that is what it is. But I don't mind this. I don't mind the sweep of the INWOG to a potential UTAD of this range. I don't mind targeting 142, taking a good chunk off, and then targeting 140 for that potential path of least resistance to potentially the 137 to 139 gap, kind of being the end all target. which would give you about 2.5 to 4 to 5% move. Now, obviously, if we see a breakdown happen before 146, I'm gonna cover my exposure and then reshort it, and then during that week of no flows, maybe post June quarterly opex, um, this gets extensive and potentially pushes us to 131 off of that. So it all depends on what happens and when. But now I want to talk a little bit about the similarities I see between this sequence and December 18th, where we had a 3% move off the Fed meeting, in terms of just the tape and volatility and the timing and the structure and the correlation between a lot of names, right? By no means am I sitting here saying that a 3% day is completely warranted, or not completely warranted. It is. I would not be surprised if we see a massive breakdown. But by no means am I sitting here, anticipating a 3% day. By no means am I sitting here putting my money anticipating a 3% day. I'm solely noting the similarities between structures that are kind of developing the same, right? So if you look over at this range, right, this post-election gap territory, right, we have a 3% move off the election, a stall within this range, a pullback into the gap, spitting the lows, and a continued rally into this notable kind of exhaustive range, right? And this is happening post August 5th and September reversal. And this is happening, like I said, at a pretty important time in terms of and range in terms of where we're at within the charts, right? So you have this notable kind of preliminary signs of a seller within this range. You have the exhaustion, and you have this kind of new week opening gap up. I'll just pull up a picture, right? You have very similar structures, right? You look at this is the November or December sequence, right? You have new week opening gap up on the 16th, exhaustion, pull into the gaps, right? Kind of just low volatile, propped up by those dealer flows, pulling into the gap from that Friday or Thursday session, and they give you the relatively weak close, right? The gap down, pullback, no true bid, stalling within the gap that we established from that Tuesday session, and then the continuation a little bit lower before a relatively decent close, and then a little bit of a run up into the report, stalling in that Tuesday gap, right? And it's kind of a similar sequence where we have the draw into the gap above, the weak close, no true bid, gap down, no bid within that range, and then a failure within the gap. This was a little bit more of an extensive move, but it fully fills the new week opening gap, and kind of develops this potential similarity between the sequences that we are having develop at hand. We had volatility, right? Very similarly, we had a big spike in August on vol, right? We had a pullback leading into the December move, where it was a 75% move on vol that day. And, if you just want to pull up this, right, from peak to trough, right, which we're just going to monitor that Tuesday closure, right, 134 days, vol was down 76%, right, from high to low here on April 7th to Tuesday's closure, vol was up 71 days, vol was down 64%, right? And even so, from Monday's low to Tuesday's close, vol was up 14% on the 18th, right? Vol was up 17% here as well, right? We saw a big spike yesterday on a 12% day on vol. And similarly as well, we have, a little bit of a digestion on vol today. Expiration as well. So the similarities are there, right? The similarities are there for a massive squeeze on volatility, right? You have a lot of people short vol after this event that happened in April, the subsequent 60% decline from those highs, 60 plus percent, and the little run up into expiration in the Fed meeting as well. So there's some similarities, some correlations, and some things that I'm not kind of ignoring, right? We have the highest volume of all time put in on UVXY, which is something that I maybe might take into consideration. And it's one of those things that I can't ignore, right? I'm not sitting here betting on a 3% day, but you have similarities in the volatility space. whether that be a couple days before, the day of, right, or just the sequence since the last vol pop. We have similarities on the index structure, right, both happening after an extensive gap, a pullback in the gap, unstructured rally with notable signs of distribution into the expiration FOMC OPEX week, quarterly OPEX week, and the potential for this to give you, I mean, dude, a 3% decline from yesterday's close just pulls you to 579 dark pool gap fill. And then maybe the gap sweep that we got similar to the 20th, right? When you look at this, gap sweep, bid the lows, maybe pull up to 570, and then we can get a rally that can be sparked with the flows Friday, right? Like if this happens, I don't mind like this. This is June OPEX rally, lower high. This is June flows. That 564 before June flows could very well be a case here, right? So I'm monitoring how this looks in the Fed meeting, right? Obviously, if we don't get that, if we just kind of stay in this range, I'm just going to look long on Friday, right? Ideally, we can see a sweep of this low taken out and a pullback into 603 range. That'll be a long opportunity for me, especially on extremely crushed 0 DTE contracts from 595 to 603, as long as the structure is there, and then continue to short Nvidia as long as we hold that 145 on a daily closure. But a little annoying going from red to green 30% to green 2 right now, but I know my risk to reward on this Nvidia trade, and obviously if we don't see, a 3% day, if we do see some pullback into the gap, I'm just going to cover it, reshort it, focus long on Friday, and then potentially look short next week on Nvidia above that 146 range. I will start positioning on Friday if we get it and hold a close though. So just a little bit of a similarity between those time frames, the potential for a move, in my opinion, to be similar to this, where it's a massive breakdown this day, a gap sweep on Friday, the second lower low within this gap, right? Obviously, technically, this is a 3 lower low accumulation, but the second low within this gap that's bid, we see a reversal, we see a reshort opportunity into July flows, maybe giving us that full 564 gap fill before July flows, and then that rally to new highs, because there's a lot of relevance behind this. I mean, there's a dark pool here, but there's a lot of dark pools layered here. And there's a lot of money built up that could, similar to this, spark that rally that could potentially spark that rally off 564 to new highs that could be the third higher high of this distribution. And what makes it a little bit more of an appealing distribution is if we get that sign of weakness, we get that really clean, easy leg, and then those flows kind of prop us up as well. Obviously could not be the case, but I mean 145 has been aggressively layered the entirety of this week in the tape. I wouldn't mind 145, 142 today, cut my exposure, right? Like I said, it's completely fine with me. That's kind of the whole target of this trade. That would be about a 40 to 50% return on July's, which is a little bit extensive of a time on this trade. But I also have the opportunity to take this to 137 if we do see a subsequent, structure that I like develop personally. So, I mean, that's pretty much it for here. That's the similarities between December 18th. That's my kind of outlook for the week on SPY with these kind of binary events and expirations that are coming into play. The potential for this to get aggressive. I mean, 3% move on indexes. This could see, 138 to 140 today. Easy. So just, I don't know. It's something that I just really can't ignore, right? I mean, we look at the high there on the 18th to low. We made a 6% move on Nvidia. This could shred, and then this could pull back into those highs or into a lower high, and then this could see 131, and then we could see these highs take it. Like, there's a lot of ways that this can pan out. I'm prepared. The Nvidia trade, I'm prepared for both. The only loss that I would take on this is if we close above 145. But either way, like I said, depending on what happens today, I'm either covering, reshorting it, targeting lower, or I'm adding in. I would like to add in, no earlier than Friday, maybe next week, adding in, covering, and looking to reshort. And there's the potential for SPY to shred. You have a gap fill up here. This could run you a little bit into the gap prior to the Fed meeting. I don't know. There's a lot of ways that this could happen, and there's a lot of similarities as well when you see how this acted prior to the Fed meeting. If we see a nice pop, a 1 point move off the minuscule gap down, and some exhaustion within this gap, not fully filling it, I don't know, dude. This is similar. I can't lie. I can't sit here and ignore the signs, but I'm not going to sit here and put a bunch of money on it. I know my risk to reward on NVIDIA as a whole. And now, if we do see 146 before the Fed meeting, that could be a red flag, right? That right there. If we see those highs taken out prior to the Fed meeting, that could be a pretty red flag. If we see this gap fill as well, right? That could kind of shift up the nature of this trade. And I'm not gonna lie, that could kind of boost my confidence and confluence in a day similar to December 18th, where it's just a massive vol short covering event that draws us into the gaps below. I'm not gonna lie, like this can get aggressive. This can happen, right? I can't. A lot of things can happen here. My focus is short today and short next week in NVIDIA. I'm leaving room to be able to long SPY or SPX on Friday, depending on what happens. But like I said, this could give you a massive footprint today, continuation into a gap sweep. You can play the long reversal, you can play the lower high, and then we can get the July flows kicking in. So that's my outlook. I'm now red on this trade, which is a little annoying. I closed up 20%, but I'm not really concerned. I know my risk to reward on this, like I said, and in a little bit of honesty, this makes me a little bit more confident in a move happening today or over Thursday in terms of like after hours and pre-market, Wednesday after hours, Thursday, Friday pre-market. If we do fade 146, is that mature? That establishes a relatively mature distribution here with these liquid highs being taken out, the NWOG attempt, as long as we get the closure, right? So yeah, that's the potential for a Friday squeeze, potential for a massive move to the downside today. My NVIDIA trade, my outlook for SPY this week, right? The kind of where I'm looking at. We're still in the confines of last week's candle, which is gross, but we never really pinned it under 595, which is a red flag, similar to the sixth fake out. That was a bad swing on my part. We didn't close under any pivotal ranges. I didn't have any clear risk, and cutting that for the loss that I could have taken, instead of cutting that for the loss and repositioning that Monday, Tuesday, Wednesday, covering some, repositioning, monitoring the vol, spike that we got on Thursday and the energy pop, and then, covering some more on Friday. Not even swinging over the weekend because we still didn't close under those pivotal ranges, right? We obviously closed within the July or June 6th gap, but we didn't close it under that swing high, right? Hindsight's 2020 though, so I can't really be too hurt. One of those things though, I positioned this incorrectly. I like the fade of the highs into this range, but it didn't happen. So yeah, currently sitting red 0.71% on NVIDIA puts. I don't know if I'll take any ads today. In all honesty, if we fade 146 today, I don't think I'm going to take any ads. I want to leave room, and I want to understand the window, or I want to preface the window extensively, right? We have the window opening up this Monday, the 9th, right? And we've been relatively pinned and compressed, and that's why it was a bad idea to swing short. But we're continuing to see those kind of dips bought, rips sold. I would love to see the outside weak taken out one way or another. That should spark a move. So yeah, that's pretty much it. Just a quick little scan recap. Not really anything else I'm super interested in. Tesla, still kind of building up this consolidation. Higher low potentially attempted here, but not really the cleanest daily candle closure. And we do have a gap below, and we do have discount of this range below. And we do have 298 here and 305. So one of those names that could trade a little bit lower before it trades higher, that I wouldn't mind happening, right? Meta, honestly, potential path of least resistance under this 703.77 gap from February, so that's something to keep an eye on. But the full gap fill here could potentially spark a leg into the NWOG as well. Apple doesn't really look good, but we're now kind of bidding the May 27th gap, right? So that's a kind of a red flag on some volume as well, with a nice leg off open, kind of shakeout print, subsequent consolidation, and a nice, rally. But we still have the 189 lows to take out, and just these two weekly lows as well. Microsoft continuing to look like fucking shit. Don't really care about that. Google holds up nicely, but I don't really have an edge like here. Amazon. I mean, they're just charts that have reverted from 130 or 160 to 218, and from 140s to 180s. AMD pop with an anomaly print yesterday is a little bit of a weird sequence to me, so it's something I'm keeping an eye on. Potentially be like a cover before a breakdown. I don't know. I don't want to bet too much on, like, I don't want to like be that guy trying to time a 3% move on indexes off the Fed meeting, but I am saying that the flags are there. I could be completely wrong, but the potential for something like that to go down, the probability is not zero, right? The probability for a similar sequence to December 18th is not zero, just like the probability is very high, in my opinion, for a short squeeze on Friday, regardless of what happens. But the confluence in a short squeeze becomes um, more in your favor if we see a volatility flush where we don't see the implied moves met off of the Fed meeting, or B, we see a massive breakdown and then like a gap trap on Friday that is propped up by those Vanna charm flows, right? So I don't know. Would align with a lot of names getting you that breakdown and then maybe a pullback into Friday, and then like a re-short to 564. Like that could happen. That could happen. I don't want to sit here and try to speculate too much, but that could happen. First lower 20 million volume traded on an 18% day yesterday's session, so we'll see about that. MU just dug in. This is one of those names. I said it before and I'll say it again. This could have been in April. I said this could be the liquidation that sparks a change of hands and that shakeout that sparks the rally to 127. Right? You have, not like an extensively matured accumulation, but you have the August 5th lows, the September lows, the earnings print from December, and all that selling kind of absorbed in terms of these highs, really getting very little progression, and then a massive capitulation where it's a 28% move from the April 2nd's closure to April 4th low day. We get the reversal, we get a nice pop on volume, and we just never got a clean structure. I mean, this was decent, the kind of sweep of this May 12th gap, the inside weeks that we put in, and then the nice 15% week the week of the following week of the 2nd. But I never really got like an opportunity. It's just that massive selling off of the tariffs that offers the hands to change and wipes a lot of sellers out of it sparks a lot of selling that party can buy. And then when this campaign is relatively mature and all the supply has been absorbed from this range, the draw is very easily up to the liquidity built up above and the highs above where there's a larger amount of supply, right? So it's pretty simple in the terms of taking out this floor of the accumulation, sparking all these stops, sparking all this selling, seeing the kind of capitulation and absorption of supply, seeing the hands change, seeing a mature accumulation, seeing the range wipe drive any supply, and the draw simply be higher, right? And that's kind of what you get. So yeah, I mean that's pretty much it for me. That's just, I mean, I have no edge on this. If you're long off 85 and you have a 28-30% breakdown, I don't really think that's a good trade to try and hold unless you're taking fat size and speculating a bottom. And we don't really get the cleanest structure after all of that. So I can't really be concerned about missing that trade. It's one of those things that it's like this happened and this massive shakeout sparks the 100% rally from the lows here. And it's a good thing to look back on and learn, right? How these lows being taken out, this massive selling in a mature accumulative range where a lot of the supply has kind of been wiped, gives you such a move with ease like this, where it's almost like no pullback, just drawing to an area with a large amount of supply, right? So yeah, like I said, I'm short NVIDIA. I will continue to be short NVIDIA. at 146. I have my risk at 145. I'm sitting red 2%. This is my target. This is my first target is 142. This is my only target if we don't fade 146. If we do fade 146, this is my first target with potential for 140 and then upper 130s, right? And then Friday, the potential for a squeeze off the off the band of charm flows is definitely in play. But also today, the potential for a massive, massive breakdown is also in play. That's not necessarily something I want to, bet the farm on, but it's something that I want to take into consideration and identify the similarities going on. Because that's all this is. It's pattern recognition. It's things that happen time and time again. It's how these, um, campaigns are established. Everything kind of aligns perfectly, and you get that extensive move, right? Nothing new ever happens in the stock market, right? It's all supply and demand, buyers and sellers, and identifying opportunities where parties can be absorbed, parties can be wiped, um, or you know, or just opportunities where a campaign is established and a catalyst can spark that um, liquidity or that counterparty liquidity that either changes the hands or sparks the leg higher or lower to a draw to the draw where there's a large amount of supply or demand depending on the situation that you see at hand. Um, in that case, vixpiration potentially exacerbating this move, causing the selling into that, unpinning volatility, and the Fed meeting potentially sparking that liquidity and that catalyst, whether it be counterparty liquidity or whether it just be liquidity in general. Um, and then, like I said, the reason for being long side focus is that buying from dealers, right? It's all supply and demand. It's just how it happens. Sometimes it's dealer positioning. Sometimes it's news events that cause that. Sometimes it's um, sweeps of liquid ranges that spark that buying and selling that change those hands. Sometimes it's pullback into gaps where you have um, layered orders, right? Where there's a lot of intent and relevance behind those gaps. So just nothing new ever happens, and it's all kind of a game of probabilities. And gaining that experience and that screen time really, really just gives you an opportunity to continue to get better, right? If there's a massive breakdown off the Fed meeting today, the only reason I would catch that and have the opportunity to identify something like that happening is because I was there on December 18th, sitting here watching that happen, looking back at it, looking how volatility and timing and everything looked. Obviously, I could be wrong, but it's just experience continuing to stack those days and understanding that nothing new ever happens. It's never going to be exactly the same, but nothing new ever happens in terms of it's all buyers and sellers and how they interact and how this auction and tape feels, right? Less than what the news actually means. Now, obviously, there is sometimes freak news that causes panic selling or massive buying, but most of the time, those will revert to the mean. That panic selling will be absorbed. The reversion will be the mean, and that buying will be sold to those late buyers and late sellers will always get trapped, and that's all it is. It's smarter people taking your money, one way or another, whether it be on that, whether it be on transaction costs and spreads, bid ask spreads, right? It's all about the big fish eating the little fish, right? 100% of the time. But understanding how those things develop, being a little bit flexible and just, um, the more the more experience you have, the better you'll be, right? The more equipped you'll be to fight these bigger battles, right? I guess you could say. Um, yeah, not a lot of volume, not a lot of aggressiveness behind this bid. Just something that I'm keeping in mind, the similarities, right? But I have my edge here. I have my execution on NVIDIA. I have the reason for being long focused. I have a good feel for the tape here. The past couple weeks have been a little bit difficult in terms of my personal execution, but I feel like now, going day by day, week by week, timing these windows is pivotal. Like I said, everything you do is just a lesson and an opportunity to get better and stack up more knowledge and experience to better capitalize on these opportunities again when they come, which I feel like something could be coming here. One way or another, I think we'll get some volatility this week. So, yeah, that's pretty much it for me. Down 4% on NVIDIA July's, with a risk of 145 daily closure. First target being 142, depending on how this sets up. These very liquid highs should be the draw, especially off the outside sweep of the 1-day inside bar pattern. Unless we see a stall within this range, I'm seeing a notable seller at the 145.50 spot. This should be the draw with the volume traded at that range and the lack of kind of digestion of that, right? If this high would have been swept, if we would have seen some slow progression, maybe. But there's a lot of liquidity built up there. Like I said, it's all buyers and sellers, and just paying attention to the tape at 146.18 is going to be an important thing for me. If that happens today before FOMC, I'm not gonna lie, this could run 5%, but I don't want to speculate. We have June opex and we have quarterly opex. I'm definitely looking to short NVIDIA to 140s to potentially 130s on these Julys, depending on how it happens. But we also have there's things under the hood that control the market, right? But this little consolidate, like we're not. I think we see some volatility this week, one way or another. Friday specifically, right? I think some volatility is going to be introduced via, like, this is the first time I've ever seen anything like this. The day before the quarterly expiration, or an expiration nonetheless, a quarterly expiration, the market's closed with an extremely volatile binary event before. Like, this could exacerbate a short squeeze. Not a short squeeze, but just a squeeze off of dealer positioning. And this is something that, even if I don't trade it, it's going to be a great opportunity to just have that in the background for maybe in 5 years when this happens again, right? So it's going to be something to kind of take into consideration, analyze, see what happens before. Like I said, depends on my NVIDIA trade, what happens first, 146 or 142. And I kind of have my targets. Like I said, 590 equilibrium. For this SPY sequence, right? We have a gap fill at 602.68. So it's just kind of depending how this plays out. But this little run up after this price action is not appealing, in my opinion, prior to this event with how volatility looks and the expiration happened today. So just taking that into consideration, and that's my outlook for the week.